In my last video, we talked about the wheel strategy. I talked about what is the workflow that I'm going through when I'm using the wheel strategy, what are the different steps and how do I go through them, what I'm paying attention to. I even gave you a spreadsheet so you can track your cost basis. But I didn't talk about one thing, which is how do I choose which stocks I'm going to use for the wheel strategy. Are there some criteria that I personally like to look at so as to select some stocks? And yes, they are. That's why I thought it was important to share with you what are those criteria, how do I personally choose them, so hopefully it's useful for you if you want to use the wheel strategy. But before diving into this video, as always, if you find this video interesting and helpful, please consider subscribing to my channel. It's really helpful. You cannot imagine how much it helps me. First criteria that I'm really looking at when I'm trying to use the wheel strategy, or at least choose the stock that I'm going to use for the wheel strategy, is a stock that I wouldn't mind owning on the long term. And it's really important to think like this, because as during the wheel strategy, you're going to get a sign on a put and you're going to have to buy 100 shares of the stock at some point. It's way better to own 100 shares of stock that you actually like, that you believe in, that you wouldn't mind owning on the long term, rather than a stock that you absolutely don't believe in. You think that the company's financials are not solid and you really don't believe in the stock. You're going to really be pissed if you have 100 shares of a stock like this. That's why the first thing that I'm really looking at when I'm trying to choose a stock for the wheel strategy is really ask myself, is it a stock that I wouldn't mind owning on the long term? And to give you an example, I'm currently using the wheel strategy on American Airlines, because I think that the stock is so undervalued, because the stock is so low, and I wouldn't mind owning the stock because I think that it has room to go higher. And when, for example, the world is going to come back to some kind of normality, I think that the stock is going to go higher. That's why I was completely confident in using the wheel strategy for American Airlines, because I think that the stock is undervalued, and on the long term, or at least middle term, is going to come back up to normal levels. And that's really this type of thinking that I think is very important when you're using the wheel strategy. Is really, first of all, even before talking about anything else, is it a stock that you wouldn't mind owning, not necessarily on the very long term, but at least on let's say 6 months? Are you comfortable having that stock in your portfolio for 6 months? That's personally how I think, and I think that's a very useful tip. The second criteria that can be very useful if you apply it so as to try to choose which stocks you're going to use for the wheel strategy is to look at the implied volatility. And the implied volatility is really like a mirror for the option price. The more expensive the options, the higher the implied volatility, and the cheaper the options, the lower the implied volatility. And you can really see that relationship between the option price and the implied volatility. And to be more precise, there is a really good indicator that tells you how options are priced right now, which is the implied volatility percentile. The implied volatility percentile tells you how does the current implied volatility ranks compared to the last 12 months of implied volatility. For example, if you have a stock that has an implied volatility percentile of 80%, for example, it means that over the last year, 80% of the implied volatility was lower than the current implied volatility, which is a pretty good indicator of how expensive are options. And the higher the implied volatility percentile, the more expensive the options based on the last 12 months of data, of course. And my point is, when you go for stocks that have high implied volatility percentiles, it's going to allow you to sell very expensive options overall. And it's going to give you a better return on investment if you choose stocks with high implied volatility percentiles compared to stocks with low implied volatility percentiles. And to really give you a good example, if you take two stocks that are approximately in around the same price range, and they have two different implied volatility percentiles, one is very high and the other one is very low, you're going to see that the options are priced very differently. And if you had to use the wheel strategy, for example, on those two stocks, well, you'd rather go on the ones that have a higher implied volatility percentile, because the options will be more expensive, so you'll get more premium when you sell the options, and so make a better return on investment. And if you don't know where to find, for example, those high implied volatility percentile stocks, I've got a very good website for you that is called Market Chameleon, and they have an implied volatility percentile screener where you can see which stocks have the highest implied volatility percentile. And instead of using the implied volatility percentile on Market Chameleon, they use what we call the implied volatility rank, which is basically they look at the high and low over the past year, and they're going to put the current implied volatility compared to that range. And technically, the implied volatility percentile and implied volatility rank aims to say the same thing: how high or how low is the implied volatility right now. But it's just two different methods of calculation, and honestly, if you focus usually on high implied volatility percentile or ranks, is going to be the same thing anyway. And if you go on that website and you see you have an implied volatility rank column, you can filter them by having the highest first or the lowest first. And it's a really good way to know which stocks have the highest implied volatility ranks, so potentially it can help you choose which stocks you'd like to use for the whale strategy. After that, always remember that you should also use stocks that you wouldn't mind owning. So if you find a combination between a stock that you wouldn't mind owning and that has a very good implied volatility rank, then I think it's worth at least looking at the options to see if you're willing to use it for the whale strategy. And I use a third criteria personally to choose which stocks I'm going to use for the whale strategy, and this one is big. Honestly, this one is so important. When you use the whale strategy, as I said, the really big risk that you can have for the whale strategy is if you see the stock falling to zero. Because if you have 100 shares and then the stock falls to zero overnight, then you lost your complete investment. That's why personally, I really like to focus on choosing solid companies. What I mean by choosing solid companies, it's more choosing companies that are volatile, yes, that have good premiums, yes, but not necessarily huge volatilities. If you look at stocks that moved a lot recently, whether it's GameStop or BlackBerry, this type of stocks, in my opinion, it's not necessarily that it's not a solid company or that they have bad financials, but it's just that there's so much speculation going on this type of company that, for me, it really makes them bad candidates for the whale strategy. I'd rather go for stocks like, as I said, American Airlines, where I know that this is quite a solid company, they have a solid balance sheet behind, and the stock doesn't have any risk to fall to zero overnight. Because when you look at stocks that have a lot of speculation like BlackBerry or GameStop, you see the stock going from $10 to $50 to $100 and then going back down to $20. I mean, it's not a healthy stock in my opinion. It's really better to go for stocks that are less volatile, even though that means maybe earning less premium, but at least you have more peace of mind. And I think it's really important when you use the whale strategy. And I know that choosing solid companies can be kind of vague as a criteria to choose stocks for the whale strategy. That's why I wanted to give you a watch list of what I think are solid companies. And you'll see that there are good stocks in there that you probably know already, or for example, ETFs. And in my opinion, those companies and those stocks and those ETFs can be very good candidates for the whale strategy depending on their levels of implied volatility. And if you find with owning, for example, one of the stocks in that watch list, you see that there is a very good premiums because the implied volatility is very high, then why not using it for the whale strategy? And that's personally really my thought process when I try to choose a stock for the whale strategy. So hopefully it'll be helpful. You can find the link in the description of the video. And if you're just starting out and you have a small capital, not necessarily enough to trade the whale strategy, for example, you can go into the first link of the description. I got invited by Webull to partner with them, and if you deposit $100 when you open an account with them, then you'll be given 4 free stocks, and those stocks can be valued up to $1,600 each. So I think that's kind of a good deal, so don't hesitate to go in the first link of the description. I hope you'll have found this video useful and you have learned something, and if you found it helpful, please consider subscribing to my channel. As I said, it's really an amazing support and I'd really appreciate it. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.